We in the area of acquisitions and measures. I'm aware that there are some students who are joining us today for the first time on this course. And by and large, those are students who are taking the junior exams. So you, dear students, what we're going to do is, I'm going to finish you with some introductory notes. The notes which will explain what is a merger, what is an acquisition first, and the recording which accompanies those notes. The second part is now where we are today, financial analysis or computation. Okay, so there's some feedback. So I was just making an introduction. I had to put a mute command, but the noises are minimized. I was directing my remarks to the students who are joining us today, so that to give them some comfort. Okay. So if you're joining us today we are doing some computations on our business valuations. That's what we are looking at today. Okay. The topic started with some theories on what is merger, what is an acquisition, advantages, disadvantages. Which notes will make available to all of you? Which notes will make available to all of you, and also recording. The second part is now financial analysis. The second part is financial analysis or computations. We'll be doing computations, and these computations are about business valuations. In the last class, we looked at methods of valuation. We looked at some methods of valuation, how to value a business. So what methods do we look at? The method that we looked at in our last class, as far as valuation is concerned, we looked at the asset-based valuations. Valuations that are based on the balance sheet values. So we looked at the concept of asset-based valuation. We also looked at the concept of market-based valuation, where we use stock market values, including the price-earning ratio and the earnings yield. Then we did say that the major method of valuing a business is cash flow based methods. Methods that are based on the future cash flows to be earned within the entity. And here we focus just on one, the use of dividend valuation model. We focus on the use of the dividend valuation model. That's what we focused on. So today we are still looking at the concept of the use of cash flows. But as we can see from our slide here, we want to move and look at the concept of free cash flow. So under cash flow based valuation, The use of free cash flow is the main method that we expect in our examinations today, where we are saying we can estimate the future value of the company by discounting the future cash flows. But what type of cash flows? A concept called a free cash flow. We can discount a free cash flow. So one of the highlights of our lecture this evening is to talk about what is a free cash flow. What is a free cash? How does it look like? So let's go. To derive a free cash flow from the financial information given, to derive a free cash flow from the financial information that has been given, what do we do? Okay. What we do is we look for an operating profit figure. We look for an operating profit figure. What is the other word for operating profit? You may remember that the other word is profit before interest and tax, or earnings before interest and tax. So we look for this figure. Okay, we look for this figure. So just 1 minute, let me share. Somebody is waiting for the link. One of our new students is waiting for the link. So first of all, you find the operating profit figure within the information given. What if the operating profit figure is not given? What happens? Normally an operating profit margin is given. So you apply your operating profit margin on the sales to get the operating profit. So we apply the operating profit margin on the sales so that we calculate the operating profit, as we'll see in the question. Then from there, from the operating profit, remember this is profit before interest and tax, you knock off your taxation. Then from there, we need to convert this profit figure into a cash flow. We convert this profit figure back into a cash flow. So the simple question is, okay, so let's go. There's a feedback that I'm struggling to hear you. Good evening, sir. I am not. This is Muiza. How is it now, Muiza? Are you able to get me? How is the situation now? What of others? Are you able to hear me?
Yes, we can hear you, sir.
Okay. So Sam, I'm struggling to hear you, sir. I'm struggling to hear loud and clear. Good evening. I'm not able to hear. 0849. Me too. Okay, so what is the challenge? Rachel is getting us there. Muiza, I'm not able to hear you. Muiza, what's the situation now? Rupe, clear, Christabel, maybe you haven't joined by audio. So there are some useful remarks from my friends there. Some are saying, maybe you didn't join by audio. Let's see, Muiza, have you joined by audio? Have you clicked on your audio? Let's see. Okay, she's joining again. Maybe now it's okay. It will be okay. So how do you convert your profit figure into a cash flow? On our paper, mainly what we have to do is to add back depreciation. We add back depreciation. So it's a depreciation which normally we add back to convert this figure, to convert our figure from being an accounting profit figure to a cash flow figure. Muiza, are you able to get us now?
Yes, I'm able to hear you. Thank you.
All right, thank you. Sorry for that connectivity. So we are talking about, we are on the road to calculating a free cash flow. And we say that the starting point is operating profit, which may either be given. If it's not given, the operating profit margin will be given. And we're going to use the operating profit margin figure to move from the sales to operating profit. How do we move from the profit to the cash flow? By and large, the only adjustment that we expect is depreciation, and it's not even all the time that you have to add back depreciation. Now, what makes this cash flow free? We are using the expression free. What makes it free is by removing routine capital expenditure. We know that capital expenditure is really one of the expenditure that we undertake in the organization. However, a number of you who are working, you know that every year you have got an item on your capital budget. Every year you know that there's going to be something on the capital budget. So this regular item that is always there, or what we call the routine capital expenditure, we need to knock it off. We need to remove it from our cash flows to make this cash flow free as the money that we expect to remain in our business. There's two types of capital expenditure. There's routine capital expenditure, which is required to maintain our current levels of operations. If we want to maintain our current levels of operations, we need to regularly incur capital expenditure. So routine capital expenditure has got two components. One, the one which is required to maintain, just to keep afloat without sinking. Then if your business is going to grow from year to year, you need another boost in terms of capital expenditure to grow your business. Organizations don't just want to float at the same level, to maintain the current level of operation just here, every year, that level. No, what organizations want to do is to grow the operations, to grow the operations, to grow operations. So this is the capital expenditure we're talking about, which is needed to grow your operations. This is one which is needed to maintain the operations to be where they are. That is what these two lines are. Then from there, you also knock off your working capital. We knock off the working capital. What remains is free cash flow. Now, to be more specific, I must adjust this slide in the future. We must add free cash flow to firm. Free cash flow to firm, and our questions are very clear. They do distinguish that we are looking at the free cash flow to firm. So what is free cash flow to firm? This is the amount of cash flow which is for everyone. Who's everyone? The shareholders. and also the bondholders. So this money which has remained after this project or this analysis is money which belongs to the shareholders and bondholders, both groups. Remember, we started with profit before interest and tax. I haven't removed interest in this computation. I have not removed interest. So the bondholders, their money is still here. The shareholders, their money is still here. So when you're looking at the equation and you are reading through a equation and they say free cash flow to firm, it means that we have not removed interest. So this cash flow is a combined cash flow, representing the returns for the shareholders and bondholders. Let us now come to the discount rate. So when we are discounting this cash flow, what discount rate are you going to use? It's a discount rate which reflects these two. It's a discount rate which should represent equity and also should represent debt. So both. Now, what do we call a discount rate which represents both, which has got both? That is what we call the weighted average cost of capital. That is what we call a discount rate which represents the equity and which represents the return for the bondholders. Is you need to take your cost of equity plus the cost of debt. Now, when you combine these, that's what will give you the WACC. So the discount rate that you must use here is the weighted average cost of capital. To discount this cash flow. This is what we call free cash flow to firm. As you can see, the next slide has changed, the title has changed. It's free cash flow to equity now. Meaning, this is the money which remains only for the ordinary shareholders. So that is why we call it free cash flow to equity. This is the money which belongs only to the shareholders of the company. So how do we calculate this figure? The answer is we still take the operating profit, but we need to knock off the interest. The money which belongs to the bondholders must be removed. That's what we are doing here. We have removed it here. What do we get? We have the profit before tax. Then we remove the tax. After removing the tax, we must come back and add back depreciation. We must add back depreciation. Why are we adding back depreciation? We want to convert this figure into a cash flow. Then again, you knock off the capex. The capex which is used to maintain your current operations, and the capex which is used to grow your operations. You knock off this. And if there's any working capital, you knock off the working capital. What remains is not just free cash flow or free cash flow to firm. This is free cash flow to equity. Why? we have removed interest. Interest has been removed here. So what has remained is just the cash flow, which represents the return to the shareholders. And when we do evaluation, the value that we get will just be the value of equity only. It will just be the value of equity. It will just be the value of equity. What is the discount rate that you're going to use here? What is the appropriate discount rate to use here? The appropriate discount rate is the cost of equity. So a free cash flow to equity is discounted using the cost of equity. Why? This money only belongs to the shareholders. And that is why after you do evaluation, what you find is just a value of equity. That's all. What you find is a value of equity. Only. The bondholders have already collected their money. Their value has been collected already. So I hope this explanation has enabled you to identify what is free cash flow to firm and free cash flow to equity. Yes, Mr. Mufuela.
I want to find out why is it that on the free cash flow, we subtract depreciation, and when it comes to free cash flow to equity, we add it back.
Okay, let's just go back. Let's go back. Here we are. Add back depreciation. Add back depreciation.
Okay, I've gotten it. Thanks.
All right.
Okay.
All right.
Thanks.
Thank you. Thank you. Don't worry. We are learning. Now, let us go to the actual doing now. Okay. We'll talk about these variables. Now, time has come for us to go back to our question, to our nice question. Let's go to a nice question. This is the question that we have been running with. And those that are joining us today, we are going to give you a recording which has got the whole of this question analyzed. The whole of this question analyzed. So you're going to have that recording. So your duty will be to go through. What am I talking about? We have already covered, we have estimated the value of this company using the asset-based approach, the price earnings approach, the dividend valuation model. What is remaining is this one now. This is what we haven't done. And basically, this is a free cash flow. And in this exam, the examiner wanted students to use a free cash flow to equity. Why? Because the only discount rate that he gave was the cost of equity. That's what we are given. The cost of debt was nowhere, the work was nowhere, and the company didn't have debt as such other than just the finance charges that they had. So this is the free cash flow to equity. Where are the parameters to enable us to work out the free cash flow to equity? Where are the parameters? What parameters have I spoken to you about? Operating profit. Did this question give operating profit? Let's go. Let's go. Did the question give operating profit? Let's go. The question didn't give operating profit. Instead, what did they say? They gave an operating profit margin. Operating profit is expected to be 8% of turnover. So they have given you 8% on turnover. And to remain at the same percentage in the future years to come. Where is the turnover? Where is the turnover that we are going to use in the question? The turnover to use is here. Barcelo's turnover, wireless link is expected to increase Barcelo's turnover by 25% for 3 years. So 25% for the 3 years. And 10% per year after that. So we need to grow our sales for 25%, then beyond 10%. So that will give us our operating profit. After that, what happens? What other variable do we need? The other variable that we need is here. The other variable that we need is here. Working capital has been mentioned. Interest payments and non-cash expenses are expected to increase at the same rate as turnover, which is the 25% for the first 3 years, and after that, 10% forever. So our interest will be increasing. Our working capital will be increasing, and non-cash expenses. So we've got some non-cash expenses too. Yes, please, Sekule.
I think I'm a bit lost because for my side, I'm looking at the operation profit before exceptional items, which is the 1.3 million. Is that the figure that we are going to be working from on the operating profit?
No, we are going to focus on sales. And we'll take 8% of that.
Okay, and why is that the case? Because I think if I was working through the question independently, I would have looked at the operating profit.
Okay, it's because of the note which was given. The note which was given, the note says operating profit is expected to be 8% of turnover in 20x6 to x7. We are looking at the future cash flow. So they have given you an indication of what to work with for the future. And to remain at the same percentage in the future years.
Okay, no, I understand.
Welcome. Excellent. That's the spirit you want, to ask questions around, because it's when our mind is troubled that the learning is taking place. When the mind is quiet, the learning is not taking place. But when somebody is troubled by something and they want Mr. Piri to explain why or why not, then the mind is learning. So for now, then, let's go to a table and implement at least the first item. Let's go to the table and implement the first item. Yeah, so we want to implement the first item. So let's implement the first item. Let us implement the first item. Shall we implement the first item together? So we've got our years here. We've got the years there. The first 3 years, you've got these years here. There we are. So you've got the first 3 years, people there. I hope we can see that. And you're going to notice that on this topic, by and large, this is the format that you'll be using. Now, what are the sales? 1 year from now, the sales will grow by 25%, and this will continue. And this will continue. Now, some of you may say, take us back to the original statement. The original statement is here. 22,480. You grow it by 25%. Or multiply by 1.25. What did you find? What do you find? 22,480 multiplied by 1.25. I'm sure you are all getting 28,100. Then grow it again and grow it again. The operating profit is 8% of each one of these figures. 8%. That's the operating profit figure. 8%. Now you notice that the question I gave you to read through, it will be the same. It will be sales, and we apply an operating profit margin on the sales. But because this one is a free cash flow, we need to bring the interest. Where is the interest? We showed you the note. We showed you the note. Let's come back here. The interest is here. This interest will grow by 25%. So you take your calculator, you grow 280 by 25%. And what happens? You're going to find these figures here. And this will give you a profit before interest and tax. Then we are given the tax. We need to knock off the taxation. Where is the taxation figure? Where is the taxation figure? Note number 2. There we are, 30%. So we knock off 30% to get to profit after tax. Then after that, we need to add back. We need to convert that figure to a cash flow. So how do we convert profit to cash flow? The profit figure that we have. How do we convert this figure? How do we upgrade it so that becomes a cash flow? We need to add back depreciation, and in this particular question, they have made reference to these items growing. So note number 1, have you seen note number 1? Non-cash expenses, including depreciation, are 820 in this year, X5 into X6. What of for the foreseeable future? These are included in note number 4, and they are growing at the same rate as the turnover. They are growing at the same rate as the turnover. They are growing at the same rate as the turnover. Okay. Which figure? So you take your 820, grow it 1 year from now, You multiply by 1.25. Then again, 2 years from now, 1.25. Year 3 again, 1.25. So year 1, year 2, year 3. Is that okay, my team members? Is that okay, my team members? Hmm? So let's feed in the figures now. Setule?
Yes, so my question right now is, I can see you are able, because now we are doing the question with you and you are showing us how to pick out the information. What advice probably could you maybe give us if we're working on a question like this on our own to be able to decipher all this information? Because again, I'm thinking at myself doing this question on my own. For example, the comment around the non-cash expenses, I only saw note 1, but the fact that it's included on note 3 again, I had not, on note 4, I had not noticed that. So how do we actually manage to pick up such legal details when we are doing these questions on our own?
Okay, here's the answer. Number 1, you need to be familiar with the format. In other words, you must anticipate. That's the only way. We cannot shoot in the dark. No, it's dangerous. We don't have the time. We need to anticipate that, okay, a free cash flow question, I expect my operating profit. And if it's to equity, there'll be my interest. And I expect there must be some items to add back to arrive at the cash flow. So 1, that is why we took a bit of time to explain to you, how does a free cash flow look like? So as you read through, you start looking for those items. Now, the comforting factor is that when I take you through exam questions, you notice that the pattern has been standardized somehow. The pattern has somehow been standardized in terms of how to arrive at a free cash flow. So after 1, 2, 3, 4 exam question, you realize that free cash flow actually has got standard items, which as you read through, you anticipate them. What are the items you anticipate? Your operating profit margin. How do you convert profit to cash flow? And what is the routine capital expenditure? And in rare circumstances, what is the working capital? I hope that is useful. Thank you very much for the question. Was there any routine capital expenditure in our question? Let us check whether there was routine capital expenditure in our question. Was there routine capital expenditure in our question? Let us check. Note number 3, what is it telling us? Note number 3, what is it telling us? Capital investment was 1 million in 20x5x6 and is expected to grow at approximately the same rate as turnover, meaning that every year there's a routine capital expenditure. Then there's capital expenditure which is there every year. Routine capex. And these routine capex in X5, X6 is 1 million. Then it's supposed to grow by 25%. So this is how, now this one probably was a bit hidden. In the most recent questions now, it's very straightforward. I'll be doing a question debrief for the question I've given you. and you notice that you won't have to struggle to see the capital investment which comes every year. Okay. Good. This question also has alerted us in note number 4 that working capital will be increasing. Now, what is working capital? Who remembers working capital? What is working capital? Current assets less current liabilities. So here we can get it. We've got our current assets there. We've got our current liabilities here. So the current working capital can be calculated here. It can be calculated here. So I want somebody now to add that figure, that figure, that figure, and that figure. I want somebody to add those figures for me so that I identify my current asset. What's the current asset?
6206.
6206.
06.
Okay. The current liabilities is 5,520. You subtract. What is the working capital currently?
686.
686. This figure is the one which will be growing. This figure is the one which is growing. 25%, 25%, 25%, and 10%. That's the figure. So I've identified 2 items: routine capital expenditure and working capital. And these are the items that we are looking for when we are doing our free cash flow to equity computation. This is the cash flow that you are looking for in this particular situation. So your routine capital expenditure, remember it was 1 million. It will now grow. Working capital, remember, working capital, here we are. 6206 minus 5520. What was the answer that you found? You found 686. So now let's grow 686. 686, you grow it by 25%. What does it become? It becomes 858. So 25%, 858. 25%, 1072. 25%, 1340. So what we are going to, this is already in your business. The cash outflow. The cash outflow is the increase. 858 less 686. 1072 less 858. Just like we did in investment appraisal, just the increase is what we capture. And these are the figures that you can see here. So we have captured the items that converts our operating profit into a free cash flow. And in this case, a free cash flow to equity. So with all that now, we have your data here. So that's your free cash flow to equity. Why to equity? Why to equity? Huh? Why to equity? We have removed the interest. Where is our discount rate? Let's pick our discount rate. Our discount rate team is here. They gave us a cost of equity of 14%, which can perfectly be applied on what? It can be perfectly applied on what? The free cash flow to equity. So since we have free cash flow to equity, when discounting, we are going to use the cost of equity. Okay, that is all right. Let us come here. So we are focusing on the first 4 years. We are focusing on the first 4 years. So I'll go, do you remember how to get a discount factor? Yes, equals 1 divided by 1.14. Here we go. We pick that again, divide by 1.14. And there, I'll simply copy my formula there. So these are our discounting factors at 14%. So the present value for year 1, year 2, and year 3. What of beyond? What of beyond? What of beyond? After the first 3 years have been completed, what is happening beyond year 3? We have a constant cash flow growing at 10%, not a constant cash flow. We've got a cash flow growing at a constant rate. We've got a cash flow growing at 10% per annum indefinitely. How do we discount such a cash flow? The mother formula where this comes from is the dividend valuation model, where we say the share price equals dividend after 1 year divided by cost of equity minus the growth in the dividend. This is really the mother formula. This is the basis. On that, in this case, we do not call it, we don't call it dividend. What do we call it? We call it a free cash flow. We call it a free cash flow to equity. So you take the free cash flow to equity after 1 year. This one is the same as this one. So take a free cash flow after 1 year. Then you divide by the cost of equity. Now, because it's a free cash flow to equity, what we use the cost of to equity and the growth in the free cash flow. This gives us a value at the end of year 3. Remember in the last class, we took a bit of time to explain that concept. We took a bit of time to explain that concept. That's what we did in our last class. So let's go. There we are. So we take 1456. Have you seen where 1456 is coming from? We take this one. That's what we put here. To convert it to F1 multiplied by 1.1. Then you divide by the cost of equity of 14 less the expected growth rate of 10%. So when you do all this correctly, what we find? We find this figure here. This is the figure, the value at the end of year 3. It's a present value, but as at end of year 3. For you to find the present value, you need to discount again using the year 3 discount factor. Using year 3 discount factor. There we go. There we go, people. So now we have converted this into a present value. So the present value, this value was captured in year 3. Present value, the discount, you have 27 there. And the final answer is here. So the value of equity using the free cash flow approach is 29,723. 29,723. Are there any questions, good people? Are there any reflections?
Yes, I have a question.
Please go ahead.
Where you said it would grow at the rate of 25% as well. Yeah, is it X5, X6? Is X5, which one is X6?
Okay.
Do we grow it the very year, or it should be the following? I'm a bit confused to say, when do you apply that growth rate?
Okay. Okay. So the current year, that's a very good technical question. The current year where we are is the year which started in X5 and ended in X6. So you can simply say it's our X6. This is our current year. 1 year from now, that is your X7. That's your X8. And that's your X9. Today we are in X6. So in the business valuations, we are saying what's the present value of the cash flows which will arise in the future? And the first one is 1 year from now. So 1 year from now, so we are here. So we're calculating the figure. What will it be a year from now? A year from now. Let me put your question here again. Let me put our question here again. So your X6 is here. So this is your X6. In other words, this is your year 0. So you got year 1, year 2, year 3. So this is your X7. This is your X8. This is your X9. So we are growing this figure here because the question we want to answer is, we want to sell this business. So what's the value of the cash flows that this business will generate in the future? So you are here. So you start, you grow it 25%. The first year has ended. Another 25%. the second year has ended. Another 25%, the third year has ended. Hello, Mama, have I answered your question? Have I answered your question, madam?
Yes, you have. Thank you.
All right.
I have a question too.
Yes, please, go ahead.
I note that the free cash flow for third year in total, the
Yes.
free cash flow.
Okay, let me get to there. Let me get to there. Okay, there we are.
Yeah. So we are saying that the beyond 3 years,
Yes.
the cash flow grow by 10%.
Yes, every year.
But when you are not this, are we going to assume that all the elements that is making up this cash flow that we have built will reach that all the elements grow by 10%? Because in the question, it is only the turnover which is said to grow by 10% beyond 3 years. So are we going? Did the examiner assume that, or should we assume that all the elements of the cash flow grow by 10%?
Yes. Let us.
Then
Let us.
or second, then secondly, is it likely that we may face a question of this nature? We may face a question where some elements of the cash flow may have different growth rate beyond 3 years. For example, maybe turnover in this case is 10, then they'll tell you interest will grow at 5, and other elements having different rates. How do we tackle such?
Okay, fine.
Thank you.
Thank you very much for the questions. So let's look at the elements. The question says, for instance, let's pick that one. Let's pick one item here. Capital investment was 1 million in this year and is expected to grow at approximately the same rate as turnover. So what does that mean? It means it's linked to turnover. So when turnover is increasing by 25%, what do you expect? These items also grow by what? When the turnover now switches to 10%, these items will be growing by what? That is the answer to that question. Working capital, interest payments, and non-cash expenses are expected to increase at the same rate as turnover. So whatever it is that is happening to turnover will also happen to all these elements. And that is why we just capture it at free cash flow to equity.
Okay.
Can these items grow at a different rate? We'll answer that question in 2 ways. Number one, under the current exam dispensation, we haven't had such a situation where items are broken down and growing at a different rate. Okay. If that did arise, of course, it will take a bit of work because it means that these items, when it comes to discounting, will have to be discounted separately. Okay, so that in that situation, which we'll comment on, we are saying that, well, that question then the examiner would really throw us in the deep end. Why are we saying in the deep end, especially in an exam scenario? Okay, the answer is, have you seen what is happening here? There's a growth factor here that we're using when we're discounting. Now you can imagine if the growth factors are different. Yeah, that will be a very interesting academic question then, which we may have to, we may have to build a model of some kind, we might do some modeling of some kind to run that sort of a situation. From your examination, no, we are only given a block figure of what is going to happen after the year, the normal planning horizon. How would you know that? The examiners' reports have always indicated that the students who seem to do well on these papers, whether you're doing AFM, APM, or AAA, are students who have practiced a number of questions, meaning they have become so familiar with what is examinable and the formats, and they would have discovered that on our exam, there's normally a block figure beyond this year. So even as they are working, they won't even worry about that. So that's the advantage of practicing as many questions as possible, because in no time, a pattern will emerge. So that is a comment that I can also put in. Thank you very much for the questions. Thank you very much for the good questions.
Okay, sorry, I have just a question. I think I might have just missed it.
Yes.
The interest rate, what interest rate were you using?
Okay. What interest rate did we use? Let's go back to our question. Let's go back to our question. The interest was given here. The interest was given here.
Yes, as the net.
Yes, the 280. So you just pick the 280 is the one which is growing. So the 280 will be increased at 25%.
Okay, okay, Mr. Piri, thank you.
Thank you. Okay, are there any more questions? Feel free to ask the questions. We appreciate